Scott?
Thank you, Mr. Chairman. Thank you for the witnesses for investing your time in trying to help us to understand and appreciate the actual impact of Dodd-Frank on our country and specifically on the most vulnerable. To me, as I listen to both sides have this conversation, I'm disappointed in the tone. I am concerned that as viewers watch this at home, that the reality of it is that they're missing the point. We're missing the point for the average person in the average place in this country who suffers on a daily basis because of financial stress. The facts are very simple. Mr. Zawicki, love to chat with you about the facts. As a kid growing up, just by circumstance, I went to 4 different elementary schools because poverty has a transient nature. You move a lot. And so when I think about the impact of Dodd-Frank, I think about the impact of Dodd-Frank on the poor, very specifically. And to me, it's pretty clear, the facts are very clear, that Dodd-Frank makes it worse for people living in poverty and people living on the threshold of poverty. Question, if in fact Dodd-Frank stays as it is, there will be, in my opinion, more payday lending and not fewer loans. Is that accurate from your perspective?
Yes, Senator. First, let me say I went to high school in Greenville, South Carolina, so I feel like you're my honorary senator in some sense.
Move back and vote, please. If you agree with me. If not, just stay where you are.
Well, I agree with you. Yes,
you,
that's who's borne the biggest impact of this. And basically, what happens is we've known this for decades, which is if you take mainstream products away from people, you drive people down the credit ladder from credit cards to payday loans and overdraft protection to pawn shops and so forth. And so that's what we're seeing, unfortunately.
And I only have 5 minutes. I'm going to try to use my 5 minutes as quickly as possible. But in other words, there's a correlation. The higher the fee, the lower the access.
Correct.
It's kind of a simple concept.
Yes.
So in the end, then, if we have, according to some studies, 2009 through 2011, a million more unbanked consumers, that translates to more people finding access to credit outside of the banking system, which means higher interest rates.
Check cashers, payday loans, pawn shops, and the like. Exactly right. They're forced to rely on those products instead.
And this should be a simple concept for us to understand and digest here.
Seems like it to me.
I must be missing something. Third point, first-time home buyers fell for the 3rd straight year. Now, according to the statistics, 74.1%, I think it is, of white folks own their homes. Around 45% of African Americans own their homes. If first-time home buyers have fallen for the 3rd consecutive year, logically, the disproportionate impact are on people of color and folks living towards that threshold of poverty. Is that a fair conclusion based on deductive reasoning?
Yes, that would follow.
And the data, frankly.
Yes, as a percentage of home buyers, yes.
Another outstanding and stunning fact that is hard to argue with is that the African-American unemployment rate is about 70 or 80% higher consistently than the white unemployment rate. The Dodd-Frank legislation makes it far more difficult for first-time business owners to find access to credit. In South Carolina, small businesses is the heartbeat of our economy. From my perspective, having been a small business owner for about 15 years, the reality of it is that you hire folks from your neighborhood, from the place where you do business, which means that if you have fewer businesses in minority areas, you're going to have a higher unemployment rate in those areas. Dodd-Frank has had, have we seen more small businesses or fewer small businesses?
We've seen fewer small businesses. We've seen loss of small banks. And of course, as you know, women in particular are disproportionately start small businesses as well as minorities. So that's particularly important to those communities and those folks.
And the final thought before I wrap this up on the Durbin Amendment, which we've heard so much about. If billions of dollars were transferred from banks to big box retailers, one of the ways that you can figure out whether or not there's been a passing on to the consumers, look at the prices.
Right.
This is not a hard thing to discuss. Now, here's what you'll hear as I depart and go to my next meeting. You'll hear from both sides a conversation about how we need to do better for the consumer and how we need to protect the consumer, when the reality of it is that the goal of protecting the consumer has been lost in Dodd-Frank, and the CFPB is not making it easier for consumers to have access to credit. They're not making it easier for people to experience the American dream. They're not making it easier for any of us to see the goal of the most vulnerable in our society being protected. It may be well-intended, maybe the intentions of the legislation, right, but the facts are inconsistent with that reality, no matter how we spin it up here. Thank you.
Mr. Chairman, may I just respond to that? Senator Scott, one of the statements you made was that the payday lenders, when they come in and they are driving individuals out of the banking business.
Actually, I did not make that statement. My statement was simply this, that as a result of higher fees, you'll have more people unbanked. And if you have 1 million people unbanked, the question then is, where do they go to get their access to credit?
Absolutely.
And they get their access to credit from, as you call it, predatory lenders or payday loans or some other access, whether it's pawn shops or something else that's close in proximity to where they live. And so then the question becomes, what is the interest rate because of the result of Dodd-Frank increasing the cost of doing business and running some folks out of banks? What is the cost to society and what is the cost to the poorest communities? The actual cost is a higher interest rate because of the result of Dodd-Frank.
What I wanted to point out, first of all, payday lenders were around, started out in '85, before Dodd-Frank. Secondly, payday lenders require individuals to have bank accounts. So they have bank accounts, and they have first access to those bank accounts. And that's how they keep them in the cycle. And it has been consistent in poor communities in our country that poor individuals, the weakest and the most vulnerable individuals, have to pay more for everything. When they purchase in their community, their prices are high. When they go to get credit, their prices are high. We use this statement, they're at risk. In fact, what we do is we develop a consistent area where people are in perpetual poverty. So my position on this, my view on this is that when we have these predatory lending practices, when we have, everybody in here have arbitration clauses that are bad in their contracts. Unless we have somebody, some watchdog group, like the CFPB, looking out for the most vulnerable, we're going to always have that small cadre of community in America who will have to pay the most and get the least out of what this country offers.
Well, let me just say this, Reverend. Thank you for your service to the country. Without any question, the National Baptist Association is a fantastic organization. I think your passion for people is right on spot. I would just disagree with our conclusions. My conclusion is a simple conclusion, that the way that we increase the cost to the most vulnerable in our society is to increase the cost in an area where the fees are lower, that the interest rates are lower. So if you increase the fees and you shrink that market, the unintended consequence is going to be higher unemployment in those very areas that we both want to help, higher costs at the grocery stores or whatever the food mart is in those areas, and a very difficult time to increase the employment opportunities and entrepreneurs in those communities, because those communities are the communities where I have lived the vast majority of my life. So the goal of having a watchdog agency that provides the type of protection that we both hope for is not happening as we are watching it unfold today around this country. So I don't disagree with the fact that the goal of having an agency that provides greater protection is a wonderful goal. I am simply saying that the CFPB is not that agency, and the results of Dodd-Frank has not been that goal. It has not been achieved. It is not getting closer to being achieved. It is getting further away. The fact of the matter is that as we eliminate small banks in small communities, the reality of it is they don't go to bigger banks. They go to a different market for their access to credit. That's just the unfortunate reality of the facts, no matter our goal. So I don't disagree with the goal. love to work with you on seeing that goal become a reality. If we study the CFPB, we will conclude that, unfortunately, with all the good intentions, the reality is the poor are still getting poorer, and that's why the poverty rate in America is 15%, and in the African American community, it's 28%. So when we look at the facts, we find ourselves with a big question mark on why are these not changing. And I will submit this to you. I'll suggest this to you, that as we watch this unfold for the next couple of years, let's just see what happens. And if we are both around in 24 months, I would love to have a conversation about what has happened because of our conversation and Dodd-Frank.
I certainly appreciate that. I just want to make one comment.
Yes, sir.
Maybe it's just in New Orleans, Chairman Shelby,
Go ahead.
or in Louisiana. And I've heard my colleague here, Mr. Zawicki, talk about the disappearance of small banks. Now, we have to understand there are some variables in terms of the disappearance. Some disappeared because they were just bad banks. But many community banks purchase those small banks. So I deal with small banks. Most of our churches in the National Baptist Convention deal with community banks. But many of those community banks are the ones that are providing access for us.
Yes, sir.
But they bought up other small banks. We have a plethora of small banks. They are not mega banks, but they are still community banks. What I'm simply saying is that when it comes to payday loans, when we have some banks in some communities move out, then we have payday loan individuals move in. Individuals who are purchasing, who are going in for payday loans, it's not a matter of the fact that they don't have banking or they don't have a job. They have a crisis in their lives, and small dollar loans are not available from some of our banks that the way they should be. Our National Baptist Convention is in the process of establishing a structure with our 31,000 churches, and we hope to be able to provide small dollar loans. But if we do not have some enforcement on the process, there is just no reason why someone has to pay, who's at the bottom already,
Yes, sir.
has to pay 400 or 500% when the interest rate that the feds have been giving over the last 8 years has been 0.25%.
Yes, sir.
It is immoral, it is unbiblical, and it is a shame.
I don't disagree with you at all, sir. And I would say thank you to the committee for your indulgence here. I'm a fan of the Bible and a fan of the Proverbs about usury fees. So there's no doubt that I don't disagree with you at all. The only question I have is, can we achieve the goal that you want us to achieve through the CFPB? And my answer is, I don't think we're getting closer. And we can measure this progress or the lack thereof over the next couple of years. We'll hear a lot of conversation, and some will, Senator Warren will tear up what I've said to pieces. I would love to have a chance to come back and respond to hers as well. But the fact of the matter is that let's just watch and see what happens to the most vulnerable in our society as the good wishes and the good intentions of this Congress does not produce the results that we want.
Since you mandated the CFPB to do these things, let us work together with them so that we both reach that outcome.
I would love to
Thank you
replace
so
them
much.
and work with you anyways.
So, well, that's the difference. Thank you, sir.
Senator Warren, thank you for your indulgence.
That's fine. Thank you, Mr. Chairman. You know, Senate Republicans